Hello. We'll wait a couple minutes. Okay, so when we acquire the asset, the idea is that you have to put a cost on it, and this is the historic cost principle. So as you see from the textbook, the costs are all of the expenditures necessary to acquire an asset and make it ready for use. So it's not just the purchase of it or the purchase price. It's not just the debit to the asset and the credit to cash. There are other um, expenses that are going to be required there. So you can see their closing costs. You have to pay for attorney's fees. You might have to pay for accountant's fees. With land or building transactions, housing transactions, you have to pay real estate commissions. And then, of course, there are taxes that might have to be settled on the land that were assigned by the purchaser to the buyer. So these all become part of the cost of land. So here's an illustration. Just take a look through it. What is the amount that has to be reported as the cost of the land? So you see here, cost of land, and then you're going to break down the old building, and then you're going to put up a new building eventually. But right now, it's just getting the land and clearing the old building, paying the attorney's fees and the real estate broker's commission. And then you have a piece of raw land now, even though it had a building on it, that is going to be ready for putting the building that you want on it. So really, you bought this whole thing just for the land. So here we see that the land, the cost of the warehouse removal, less anything salvage value that you could get, the attorney's fees, and the real estate broker's commission. And thus you see the true cost of the land here now at $115,000. Then land improvements, so driveways, parking lots, fences, landscaping, and underground sprinklers. These all have limited useful lives. Driveways, parking lots, you understand that already, right? Every so often, the parking lots outside at KCC get torn up. They get repaved so that they are easier to drive on, don't cause so much damage to people's tires, and maybe even people slipping and hurting themselves. Same thing with landscaping. The plants change. They got to be uh, taken care of. Sometimes it's very vital for business. You might remember that about a month ago, or maybe 2 months ago now, a branch fell off a tree at the Sinclair Library area and hit a student on the head, knocking that student unconscious for a few days. And that's really bad. And that's liability to the school. And that's something that would not give the school a better name. So you got to make sure that you keep the place nice and safe. And also, landscaping has limited useful life. Trees, as long as they are there. And I was just admiring that big banyan tree outside the class the other day. Um, but they do not last forever. So there is a limited life there. You just have to estimate what it is. And then we depreciate this. We talked about depreciation a little bit before in a more informal way through the idea that, let's say we buy a computer for $5,000. Computer is expected to last for 5 years. Even we're following the cash method and we spend all $5,000. Currently, we're only going to be able to get to deduct 1/5 of the cost of the computer every year. Since it has 5 years that it's going to last us and give us service, we take off 1,000 of depreciation every year. Then buildings, of course, same thing, all purchase cost. Notice that there are a lot of professional costs, attorney's fees, brokers' commissions, insurance, and things of that nature. You might have to have architectural inspections. As you see, they're remodeling, replacing, rewiring. This all goes on to the building if these costs were done before the building was usable for our purposes, whether as our own offices or something that we decided to rent out. Equipment, so here it says that include all costs incurred in acquiring the equipment and preparing it for use. So this is going to be the cash price. So again, let's say we buy something for $1,000. We know state taxes here, excise taxes are going to be $400 and $4, what is it, $40, $45 or so, right? And then so $1,000, $45 for the excise tax. Any transportation in FOB in charges, FOB destination charges go on to the cost of the equipment. So let's say to get it shipped here to the islands, it cost us $100. So now that's another $100 of freight charges. Insurance might have been included in the freight charges, or we might have had paid extra for it. If we paid extra, let's say $25, and expenditures in assembling, installing, and testing the unit. So let's say it was one of those that you have to assemble, like IKEA kind of furniture. There's actually a place here that you can buy the IKEA furniture, ship it to them, and they'll assemble it for you. But they will charge you a fee for that because they're a third party. So that might also be a fee that you'll have to deal with. So here's the illustration again. We paid $22,000 for the truck, 1312, 1320 for the state taxes, uh, painting and lettering, logos, decals, $500. So our total cost of the truck is 23,820. Notice that the 3-year accident policy is not included, nor is the license expense, because these are annually reoccurring fees. So when we have annually reoccurring fees, what we need to do is to um, expense those. That would be on the income statement on a regular basis, and not added it into the price of the vehicle. So I've already started, so as I guess you can tell. So we're going through uh, looking at now the journal entry for this truck. Remember, the entire truck cost us $23,820. The license expense was $80. This is another fee that had to be paid, but that was just for this year. Remember, like the licensing fee you pay for your car, you have to pay it every year. So when you pay it the first year, it's a first year expense, but it is part of the cost of getting the vehicle to the business. Then the prepaid insurance, and then finally the total cash that's been outlaid. Remember, we do have to account for the entire amount of cash that we pay, debits with the truck, the expense for the license, the expense for the prepaid insurance, all required cash. And as a result, we add those all up. 25,500 is the amount of cash that we have to pay to acquire this vehicle for use in our business. Now, we also have these other kinds of expenditures that occur during the life of the vehicle or the building, and this is what we call ordinary repairs. You just gotta wash the thing. You gotta put gas in it. You gotta put oil in it. You gotta change tires every so often. These things get debited to maintenance and repair expense, and they're referred to as revenue expenditures. So, in order to make money, you have to spend money. If you need that vehicle in order to help you to get things delivered or get stuff there to your factory, then that's a revenue making expenditure. It says additions and improvements are costs that increase the operating efficiency, productivity, capacity of the useful plant. So here what you do is you debit the plant. This is a capital expenditure. So let's say that you have a building, you've got an assembly line in it, and that you have a need for a new assembly line because let's say that you're going to miniaturize some of the pieces so that you have to take out some of the old machines and put in new machines. But the use of the new machines will basically increase the life expectancy of the plant. So let's say with the big old clunky pieces and in this assembly line, you could not be competitive beyond this year because everybody else is going with the more cost efficient micro units. Okay, you put in the addition or the improvement to replace the old assembly line with the assembly line that now uses the more efficient micro units. And now let's say that you can continue to produce product for another 5 years. So here, um, what you do is you would increase the life expectancy of the asset, and then you would cost out the addition for another 5 years because that's how much more time it's going to give you as far as making these things that you're going to sell. Uh, Still on fraud. This is one of those big cases from the past. A guy named Bernie Ebbers, he founded WorldCom. They were a cell phone company, essentially. You don't hear of them anymore because the guy stole all the money. The company engaged in a series of increasingly large debt financing positions. This guy was kind of interesting. You see there He just basically directed his accounting staff to put down something that was supposed to be an expense, so like a bill of expenses, as a item of income. So he just basically lied about what it was, and his accountants didn't want to challenge him, and the whole thing basically led to a situation where the company's books didn't reflect anything of what was really happening. So the company was essentially bankrupt, but it looked like it was doing really well. And that's because the guy was just making fake numbers. And the total loss, as you see, it was 7 billion. And the problem was the missing controls. Sometimes it's that simple, but many times from an ethical perspective, and then from also your own personal perspective, the question you have to ask is, would you stand up to a bully? If you had a boss that was telling you to do things that you knew were wrong, would you stand up to that boss knowing that you more than likely would be fired? And many times it's not just that you're going to get fired, but these guys are very powerful and they can make your life kind of miserable for a while. Just look at the Honolulu police chief scandal. The standing up to the police chief, and if you were a police officer, would cost you maybe your job, or could cost you promotions, could cost you advancement. Before you know it, maybe you end up on a fake video where you're being framed for stealing a mailbox, and people will believe the person in power and not you. So, what would you do? And this is something that you have to seriously think about, because this is going to be part of the job that you may enter. That there will be people who it's make money at all costs, and for them, um, even small money is enough to cheat over. So, they'll put you in a bad position. The question then will be, what are you going to do? And even if you just decide to quit, remember that these uh, these folks can use their power to go after you to make your life miserable. So this was the missing controls and independence. And it's hard to get independence when somebody's paying you. And if you're supposed to be independent and you have somebody paying you, telling you whether you've done an acceptable job or not, that really works against independence. So you have to think through these kind of situations as well. Um, an example of accounting across the organization, looking at how some of these companies have issues that have had to be resolved and how they went about trying to fix these. Here, an exercise on the cost of doing plant assets. And here we see the truck for 15, sales taxes of 900, delivery cost of 500, 200 for painting and lettering, 600 for annual insurance policy, and 80 for the motor vehicle license. So here what you got to do is figure out which ones are actually cost associated with the acquisition of the truck and which ones are annual costs that will have to be paid uh, independently of the acquisition of the truck. So here we see that the cost of the truck is the 15 for the truck, the 9 for the taxes, the 500 for the delivery, and the 200 for the lettering and logoing. The prepaid insurance and the licensing fee are going to be essentially deducted on an annual basis. Every year you got to pay insurance, and every year you have to get a license. For those of you driving your own cars here, you know exactly what that's like, right? Every year you got to buy insurance, and every year you got to go register the vehicle and get that little sticker that says that you've paid your registration fee. Depreciation, again, remember this was just taking back the cost of the asset over the estimated life usefulness of the asset. So again, as I said early on, we buy something for 5,000. It's going to last 5 years. We're going to use it equally each year. So each year we should deduct 1/5 of the cost. So each year's depreciation should be $1,000. At the end of the fifth year depreciation would be 1,000, and that would have recovered all $5,000, $1,000 a year for 5 years of the use of that asset, and assigned that cost, the $1,000 a year, the depreciation expense, to the expenses of each of the 5 years, so that we can match the cost over the time period in which we make money, right? So that's what the deal is here. So here we see we buy something, we estimate its useful life. If there's any salvage value at the end that we might be able to recover, we look at that as money coming in, or at least money that defers some of the cost of the vehicle to start out with, or of the asset to start out with. So what we do is we take the residual, the salvage value, and we subtract that from the overall cost, and then we divide that by the useful life. Now, in some depreciation methods, we do not use residual value. Basically, we go with the presumption that we would use up the entire asset and there would be nothing left of it at the end uh, of the period of its use. Right? So this is something again that we have to make sure that we understand. That some methods, like straight line, may use salvage value, residual value. Other methods, advanced, uh, accelerated cost recovery methods. They're accelerated because we're trying to get more of our cost back in a hurry. So we're trying to accelerate the deduction more now than later. Those will not necessarily use salvage value. Here's an illustration of this. And what we see here is we got $13,000 for a truck, 1,000 expected salvage value, 5 years estimated lifetime, and 100,000 estimated useful miles to be driven by this truck. Now it says use depreciation, straight line, units of activity, and declining balance. So here's what straight line method would look like. Again, take the 13 cost minus the 1,000 residual. What you're going to deduct over the years of service is 12,000. So the depreciable cost is 12,000. 5 years, that would make it 2,400 a year. Right? And at the end of the 5 years, at 2,400 a year, you would have recovered 12,000. You'd sell the scrap for 1,000, and you got back your $13,000. So here's how a straight line looks. And this is one of the more um, necessary ways of looking at things. So go back and look at this again later so that you can get a feel for how this works. And then, of course, look at the journal entry, as journal entries are critical. That's the way I look at things. So the depreciation expense is 2,400 and the accumulated depreciation is 2,400. Now remember, it's accumulated depreciation because it's not the truck itself that you're chopping a piece off of. You are just allocating part of the expense of the truck, of buying the truck, to the use of the truck in the operation of the business. Okay, so hopefully you understood what I just said, because you're not taking away a piece of the truck. That's why the credit is not to the truck. The credit is to accumulated depreciation. At the end of the estimated useful life of the asset, you should have a total accumulated depreciation equal to the amount of the depreciable cost. In this example, 2,400 times 5 would have been 12,000, and that would have been the depreciable cost. And we do the same thing every year. And notice what happens is that pretty much everything stays the same in the first three columns. The fourth column, the depreciation accumulated, is going up because every year we're adding more depreciation into the accumulated depreciation account. While at the same time, the book value is going down. The book value is the cost minus the accumulated depreciation, right? The cost minus the accumulated depreciation. And notice that the book value here, even though we're taking into account the salvage value because we're going to get that back at the end, right? So we're wiping out, systematically recovering the 12,000, but we still have 1,000 extra. So the book value being the cost minus the accumulated depreciation, we add back in the salvage value. Same thing happens in year 4. And finally, the last $2,400 comes off in year 5, so we see accumulated depreciation of 12,000, and the book value is just the residual value of the $1,000 for whatever scrap we could get from the asset. And this is how it would look. Now notice that here we have a truck purchased on April 1, 2017. So notice that in the first year and the last year, there are adjustments. Okay, notice in the first year and the last year, there are adjustments because as we bought this in April, we didn't use it for all of 2017. So all we used it for was the entire month of April, May, June, July, August, September, October, November, December. So we used it for 9 months or 3/4 of the year. And that's why here we see that we only take 9 of the 12 months. And that's why the first year depreciation expense is only $1,800. In the final year, remember the second year, the third year, the fourth year, the fifth year, all of it is a full year. But then in the sixth year, what happens is that we still have 3 months of usage left on the truck. So we take the 3 months back then, and that brings us to our full 12,000. So notice it's again the actual time that we use the vehicle and not just the year that we bought it in. But if we bought it in April, the 4th month, then we get 9 months of depreciation for April, May, June, July, August, September, October, November, December. And then in the final year, we get the January, February, March that we didn't get in the first year. And this is how this is accounted for. So get this off. So another example, 10-year life, $2,000 salvage value, straight line method. All right, now the units of activity method. Remember, this is something where we have an idea of how many miles or how many pieces or how many things, how many hours we can use a piece of equipment for. So here, the truck again, the depreciable cost 12,000. We're going to drive it 100,000 miles, so that comes out to 12 cents a mile. So every year, the number of miles we drive times 12 cents will give us the annual depreciation expense. So you see there in year 1, 12 cents a mile. We drive for 15,000 miles. We get $1,800 of depreciation expense. So here, again, looking at the relative amounts, And looking at the journal entry, the depreciation expense is 1800 and the accumulated depreciation is 1800. Those are the two most critical numbers that we have to journalize. Now, notice in 2018, we now drive the vehicle 30,000 miles. 2019, 20,000 miles. And basically, we see that we are capturing the expense per mile based on 100,000 miles total usage to measure as our depreciation using these units of activity. And at the end, we've used up 100,000 miles and we have used up the $12,000 and we have the $1,000 residual. Now, this is something called declining balance. It's also referred to as double declining balance because remember what we're going to do is we're going to take whatever the annual depreciation percentage is and double it. But we're going to apply it only against the balance that remains as far as the asset is concerned after taking depreciation for the previous year. Right? So we're going to be looking at a different kind of book value that we're going to be multiplying this 40% rate to. So here, what we're going to see is that every year, the base or the book value is going to be used as the amount for which we'll take the double the straight line rate, or in this case, 40% rate. Now, there will come a point in time that if we take the remaining book value of the asset and then we recalculate over straight line with no salvage value, then we'll actually get all of the expense back. Otherwise, there'll always be a little bit that you couldn't take back. So here is what this one looks like. First year is kind of the easiest to see, right? 13,000 book value, 40% is the depreciation percentage. 5,200 is the amount of the depreciation. Accumulated depreciation is 5,200. And then we take the book value, 13 minus the 5,200 of depreciation, and we get 7,800 as the amount of the book value for year two. And this is the depreciation, the journal entry that we would see for year one here. Now notice in year two, we start with the book value, 7,800, which was what the book value was at the end of year one. So year one ending becomes year two beginning. We're still applying 40%, but now it goes down to 3,120. Accumulated depreciation will go up to 8,320. And the book value will be the 13,000 minus the 8,320, or 4680. And then we just will keep following this process, reducing the book value every year, okay, until we get to a point where we're going to need to just switch it over to get everything that's left over from this. All right. So this is where we get those numbers from. All right. And you see the journal entry for the $3,900 depreciation expense based on the 9 months of usage. So remember in one of the first examples where we took the depreciation for the whole year and we multiplied it by just the 9 months over 12 months, the 3/4 of the year that we actually used it, we had a reduction to the actual usage period for the depreciation. This is just a comparison of the methods. Notice at the end of the 5 years, it always comes out to the same amount. It's just when do you get to take the greatest amount? And you see there that there are many instances in which it's better to get more money now than wait for it to come later. So the more you can get currently, the better off you are doing based on the time value of money. There are specific tax ways to do this. You can read through these. You'll also learn about these in your income tax courses. Sometimes you have to revise the period of depreciation. Yeah. Let's say you had the situation with the Galaxy Note 7 and you bought that and you were going to depreciate it over 3 years maybe. So let's say a phone lasts 3 years. I don't know what the IRS designates it as. I don't look at that. But let's say 3 years, you bought the phone for $900, and you were going to use a 3-year life expectancy for depreciation, straight line. You bought it on January 1 of year one. In year one, however, what happened is the phones started to catch fire. They all had to be returned. They were not replaced. They were just basically redeemed. You couldn't use them anymore. So you might have gotten some use of it, but then what would have happened is that you would not have gotten all the use of it because they basically made those phones not usable and actually went so far as to say that they would confiscate them. So now your life expectancy for the period of depreciation will basically be just that first year. So you do have to recalculate and change the way that you will view depreciation. Notice this is not considered an error. This is just something that happened. Right? Well, here's another example. And another example. With, along with the required adjustment for depreciation expense. All right, so I will stop this chapter at this particular juncture. It is what now? 1 o'clock. I got a few minutes left. I'm going to start on the next chapter. Just introduce this to you. And hopefully those of you who are not present on the Zoom session are looking at finishing up your presentation, which will be due the week after Thanksgiving again. And we're just going to go 1, 2, 3, 4, 5, 6. And we might finish them all on Tuesday. We might not. So even if you're in group number 6, do not think that you will not be presenting on Tuesday. Plan for a Tuesday presentation because if another group doesn't show up, you more than likely will have to present on Tuesdays, and that other group, unfortunately for them, will not pass. But be ready for that. So I would say that even if you are groups 5 and 6, be prepared to present on Tuesday, right? And everybody should be, because then that means everybody would have taken the same amount of time to prepare their presentations. What we have here is chapter 10, liabilities. We account for liabilities as well. So notice, we started with assets, which we have just been looking at acquiring them and then using them. And now we're going to be looking at liabilities. How do we get liabilities? How do we become indebted? And how do we pay them back? Or how do we lend money? And how do we collect it? So here, in Chapter 10, explain how to account for current liabilities. We're going to figure out, okay, current liabilities, what are they? Well, they're going to be liabilities that you're going to have to pay for within the current operating cycle or 1 year, whichever is shorter. So these are your rents, your utility bills, your salary expenses. They're going to be the stuff that happen all the time and happen every time. Number 2 is describe the major characteristics of bonds. So bonds basically are like long-term debt obligations. So you borrow money. It's usually secured by some kind of asset like a building because you're borrowing the money to build a building. And then it pays interest over time. Explain how to account for bond transactions. Now, sometimes what you're going to find out is that interest rates shift from day to day. As you are probably aware, uh, President Trump has appointed a new leader, a new chair of the Federal Reserve Board. This group particularly led by the chair, will determine interest rates from now on. There is a desire on the part of the administration to slowly increase interest rates. So what that means is that if you were to do a bond today at 3%, and that's the interest rate that the bond is assigned by the current administrative preferences, 3%, but they're going to raise the interest rate. And now let's say your bond takes a while to get issued because you got to get the bank, you got to get what's called underwriters. We have to get all the accountants together to make sure that they accurately price everything. And then what you find is that by the time the bond is printed and ready for sale, the current interest rate has moved from 3% to 3.2%. Now, you could either throw the whole thing away and say, forget it, or you can try to sell it, but nobody's going to buy it for the same price as they would have bought it before, because obviously now they could get 3.2% interest instead of the 3% interest that you're giving them off of your bond. So we're going to see bond discounts that occur, that when the interest goes up, the price of the bond, the face of the bond value, the discount, uh, the face value of the bond will go down. It would go the other way if the interest rates were to go up. If interest went up because the Federal Reserve instead said, well, business is not doing well, so we're going to reduce the rate, then you would get a higher percentage for your 3% bond. So now you should be able to command a higher price. And that's the kind of things that we're going to look at. How to account for long-term notes payable. Basically, you have to calculate a schedule of amortization or repayment with interest and discuss how liabilities are reported and analyzed. So again, we know that not all liabilities are going to get paid back, just like not all accounts receivable are going to be paid in. So current liability, again, a short-term period. And here, so at this point in time, we're just going to wrap it up. I know we got about 20 minutes left, but then what I don't want to do too much. I will put up in the Wiley Plus for 9 and 10, same idea, doing all of the brief exercises. You can work through all of these. If you have any questions, please make sure to raise them uh, when we are in class, because I'm not sure, how well you do with these things, because eventually the entire answer is given to you, and either at that point in time you did it or you didn't do it. And I think most of you have done it, but sometimes what looks like you know how to do it because you got the answer correct uh, is not necessarily a truthful or accurate indicator of how much you know. That's why just getting the correct answer is really always not that important. So if you have issues or if you have questions, please make sure to let me know. All right. So we'll end this now, and I will see you on Tuesday after Thanksgiving. The first group will be number 1, and we're going to go 2, 3, 4, 5, 6. So you have to have all of your um, uh, preparation already done, the slides assigned, and I look forward to hearing some interesting stories about how fraud has affected us and how we might be able to reduce that fraud and that negative effect in the future. So anyway, thanks, and see you guys after Thanksgiving.